Let me share a statistic that transformed my approach to markets: 68%. That's how much time consistently profitable market participants spend in deliberate inaction. While emotional traders chase volatility, methodical operators understand that stillness creates advantage. Today, we'll explore why disciplined waiting isn't merely beneficial, it's the essential foundation for enduring market success. Understanding market psychology reveals a fundamental paradox. Retail participants often respond to every price fluctuation, while experienced operators recognize a deeper truth. Financial markets reward precision calibration, not constant activity. Consider this: in which enterprise does purposeful non-action frequently yield optimal outcomes? Our cognitive architecture favors immediate resolution, having evolved in contexts where delay meant scarcity or danger. Contemporary markets, however, invert this ancient programming. The very instincts that ensured ancestral survival now jeopardize trading capital. Observe the typical reactive trader, monitoring real-time data streams, positioned for rapid response. This activity generates psychological engagement, yet statistically erodes account value. Conversely, the strategic participant maintains observational distance, analyzes structural formations, and reserves engagement for genuinely asymmetric opportunities. The concealed expenses of premature action function as continuous capital erosion. Each early position entry, each emotionally driven exposure, each minor deviation from established protocols compounds toward significant depletion over extended periods. Examine the mathematical implications. An impulsive operator executing 20 weekly moderate probability scenarios while risking 1% per engagement faces approximately 20% portfolio exposure for limited expected return. A selective participant identifying 3 to 5 high-conviction situations during identical timeframes risks merely 3 to 5% for potentially superior risk-adjusted outcomes. Transaction costs alone penalize excessive activity significantly. Incorporate commission expenses, execution slippage, and the cognitive burden of continuous decision-making, and urgency becomes the swiftest path to account diminishment. This brings us to the professional's distinction: active preparation. Many misinterpret patience as passivity. Professional waiting represents intense, focused engagement. It involves sustained analytical effort without premature execution commitment. Visualize a precision specialist: extended periods of apparent stillness, continuous environmental assessment, exact target identification, followed by singular decisive action. Contrast this with scattered approaches: substantial activity, resource expenditure, and questionable effectiveness. Active preparation encompasses continuous multi-timeframe analysis, monitoring institutional liquidity flows and alternative trading venues, tracking macroeconomic catalysts and sector rotations, maintaining detailed performance journals, and preparing for diverse market environments. The strategic participant isn't inactive, they're systematically preparing for maximum effectiveness when conditions align. The cumulative effect of this discipline manifests mathematically. Selective practitioners naturally achieve superior outcome ratios through rigorous entry criteria. They experience reduced capital drawdowns by avoiding marginal situations. Crucially, they preserve cognitive resources for genuine opportunities rather than exhausting attention on market noise. Consider two market participants beginning with identical capital. Participant A executes 200 annual transactions with 55% accuracy and 1.2:1 reward-to-risk parameters. Participant B executes 50 carefully selected engagements with 65% accuracy and 2.5:1 reward-to-risk metrics. Despite 75% fewer transactions, participant B typically achieves superior performance with significantly reduced stress and temporal investment. Overcoming the action compulsion represents a critical transition. Trading interfaces often encourage continuous activity through real-time data streams and rapid execution capabilities. Recognizing this design influence constitutes the initial step toward autonomy. Successful operators cultivate what I term strategic stillness tolerance. They reinterpret preparation intervals as productive capital preservation, not wasted potential. This cognitive shift transforms trading from reactive speculation to proactive enterprise management. Practical implementation involves understanding market rhythms and volatility cycles. Most actionable movements occur during specific sessions when institutional participation generates directional momentum. Outside these periods, price action often represents random fluctuation. Develop explicit entry criteria eliminating subjectivity. specific technical convergences, support/resistance levels, trend alignment, volume confirmation requirements, and risk-reward thresholds. Establish clear minimum standards, typically requiring at least 2:1 potential return relative to risk. Implement market environment filters distinguishing trending from consolidating conditions. When criteria remain unmet, the proper action is non-action. This represents opportunity preservation, not opportunity cost. The psychology of intentional non-participation challenges conventional productivity narratives. Learning to value positions not taken requires psychological recalibration. Establish alternative performance metrics, protocol adherence percentages, setup selectivity ratios, average risk-reward parameters, maximum drawdown controls. These measurements naturally reward patience while conventional profit-loss accounting may temporarily reward randomness. Market microstructure understanding reveals why patience proves profitable. Markets spend approximately 2/3 of time in consolidation patterns, with only 1/3 in directional movements where substantial gains become possible. Impatient participants exhaust resources during range-bound periods, leaving inadequate capacity for genuine breakout scenarios. Experienced operators recognize accumulation and distribution phases, awaiting clear directional commitment before significant capital deployment. They understand that missing initial movement portions while confirming direction far exceeds the cost of premature positioning. The extended benefits transcend trading. Developing market patience generates positive externalities across life domains. Decision quality improves, emotional regulation strengthens, long-term perspective replaces immediate gratification seeking. This cultivated patience becomes transferable competence, enhancing career decisions, relationship choices, and financial planning. Trading discipline cultivates life discipline. Common patience misconceptions require clarification. Many mistake analysis paralysis for patience. Authentic patience involves explicit decision frameworks and decisive execution when criteria are satisfied. Hesitation before valid setups represents apprehension, not discipline. Another misunderstanding involves perfectionism, awaiting unrealistic scenarios that never materialize. Patience means awaiting sufficiently favorable conditions, not flawless ones. Market environments periodically present exceptional opportunities with clearly defined risk parameters and substantial reward potential. These situations compensate disciplined participants for their waiting periods. Missing these opportunities due to depleted resources or diminished attention from excessive activity represents the ultimate trading disappointment. Developing patience requires deliberate practice, not aspiration. Begin by extending typical position durations. If you normally engage in minute-based transactions, experiment with hour-based holding. If you typically maintain positions for hours, consider daily frameworks. Implement mandatory cooling periods following losses. Establish minimum intervals between transactions. These artificial constraints naturally cultivate patience over time. The professional perspective views trading as extended probability sequences across thousands of engagements. Individual transaction outcomes become statistically insignificant. Process adherence becomes paramount. This longitudinal perspective naturally fosters patience. They recognize that capital preservation constitutes profit generation. Every avoided loss represents earned capital. This cognitive reframing transforms patience from psychological burden to strategic advantage. In contemporary markets dominated by computational systems and microsecond execution, individual advantages appear negligible. Yet patience remains the single advantage technology cannot replicate. Algorithms process information rapidly, but cannot wait more effectively than disciplined human operators. Your patience constitutes your unique value. Your discipline represents your differentiation. Your capacity for stillness during others' panic becomes your pathway toward consistent results. Financial markets perpetually present opportunities, for those prepared to wait.